I think that most investors, if they maintain that cash, high quality bond, broadly diversified equity portfolio, they're getting a pretty all-weather portfolio right there. I don't see the need to layer on a lot of alternative assets.
On Wealth Track, building a better retirement portfolio with Christine Benz.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. As we are all well aware, the greatest fear in retirement planning is not having enough money during retirement. Many guests have told us that it is the biggest challenge investors face. 2022 didn't help matters any at all. Being well diversified among multiple asset classes didn't spare anyone from some pain. A particularly troubling case was what happened to the traditional 60-40 benchmark mix of 60% stocks and 40% bonds. 60-40 portfolios had one of their worst years in decades, down 16%. That was the second worst since 2008's 21% loss in the midst of the global financial crisis. The main culprit was the dismal performance of bonds, which are supposed to offset the risk in stocks. Bonds experienced their worst year in history. Long-term Treasury bonds, for instance, lost nearly 30% of their value. As the Wall Street Journal's intelligent investor columnist Jason Zweig put it, instead of being ballast for a balanced portfolio, bonds turned into a torpedo. Well, how can investors protect their retirement nest egg from future market calamities? This week's guest says there is a way to build better, more resilient retirement portfolios without being as vulnerable to short-term market behavior. She is widely followed and admired personal finance expert Christine Benz, Morningstar's Director of Personal Finance, a position she has held since 2008. She writes daily personal finance columns for Morningstar, does interviews and podcasts, and is the author of several books, including 30-Minute Money Solutions, a step-by-step guide to managing your finances, and the Morningstar Guide to Mutual Funds, 5-Star Strategies for Success. She has also been named to Barron's list of 100 most influential women in U.S. finance for 2020 and 2021. We are delighted that Christine is joining us for the fourth year in a row to help us get in personal financial shape. And this year we are doing a two-part series. We need much more help after last year's market debacle. I asked Christine to describe her bucket investing approach to building a retirement portfolio.
Yes, and I always take care to credit Harold Avensky, who probably 15 years ago, he and I were talking about retirement decumulation. And we were in this period where yields were very, very low. And the old strategy of subsisting on the income distributions from your portfolio just wasn't cutting it for a lot of investors. They were having to get into riskier and riskier portfolios, all in the name of generating that income stream that they were looking for. So I talked to Harold and said, well, how do you do it? And his point was that I maintain a total return portfolio that is balanced across stocks and bonds, but I simply bolt on this cash bucket. And in a bad market environment, like a 2022, for example, we would be pulling from the cash instead of invading depreciated equity or bond assets. So that's the very simple formula where you're holding 1 to 2 years worth of your portfolio expenditures in cash. You're not taking any risk with that portion of the portfolio. Now, of course, you are a little bit vulnerable to inflation risk, given how high inflation has been over the past year plus. But the idea is that you aren't risking any loss of principal. So you're sticking with generally FDIC-insured instruments and using those to fund your cash flow needs in a bad year. In better years, you may be pulling from your appreciated equity holdings and using those to refill that cash bucket and supply your ongoing income distributions. But in a year like 2022, cash was a savior.
It's interesting that this bucket, the cash bucket, bucket one, you need to customize it, and it can be customized to your individual situation. So how do you determine what you need to have in bucket one, what you need for, liquid assets?
taking a step back and thinking about what your all-in income needs are in a given year, and ideally you would project this out a bit over a series of years, and that might ebb and flow a little bit. So I know for many of your viewers, they likely have in mind the strategy of delaying Social Security. They've heard the gospel about why it's valuable to do so. So they may have heavier portfolio withdrawals coming early on in their retirements, and those might taper off a little bit once Social Security comes online. So look at this on a year-by-year basis, but you're starting with your income needs all in. You're looking at how much of those are going to be supplied by non-portfolio income sources. And of course, the more of those, the better that you can bring into retirement. If you're lucky enough to have a pension that you're carrying into retirement, that's certainly good news because it reduces demands on your portfolio. So you're subtracting out those non-portfolio income sources from your total income needs. And the amount left over is your anticipated portfolio withdrawals. That's how much you would hold in cash investments. And then in terms of the complexion of the cash portfolio, I sometimes hear from investors who say, oh, could I hold real estate equities in this portion of the portfolio, or short-term bonds or higher yielding bonds? My bias is to really keep it quite plain vanilla, quite safe. And the good news is that yields are much better now.
The emergency funds, the cash bucket, has really been a difficult investment over the last several years because of zero yields. And so now, I mean, we've gotten a real gift. Higher interest rates, that's the one place where we're really benefiting.
Right. That's definitely good news for savers of all types. But still, with inflation, I think you have to recognize that that does erode the purchasing power of that income stream. Even though yields are better, you're probably still in negative territory on an inflation-adjusted basis, which is the reason why you don't want to overdo those safe investments, in my opinion, that you probably want to edge out on the risk spectrum a little bit once you've established that cash flow reserve fund that you'll use to fund your next couple of years' worth of portfolio withdrawals.
And then there's bucket 2, which again serves as income withdrawal needs. So describe bucket 2 and how it's different from bucket 1.
Right. This is mainly a high-quality bond bucket. And the way I like to think about it is that I'm kind of stair-stepping it by risk level. So if in some catastrophic environment I've spent through that cash bucket, there's nothing left in it, and I need to figure out where to go for my next portfolio distribution, I would hold short-term bonds. I would hold a component of short-term inflation-protected bonds. And I'd also hold intermediate-term bonds in that portion of the portfolio, and generally a high-quality fixed income portfolio. I like funds for most investors, mutual funds or exchange-traded funds that give them a lot of diversification in a single shot. But certainly I know that many investors, especially after the 2022 market environment where we saw bonds and bond funds face serious losses, I know that many investors are building laddered portfolios of individual bonds. That's a defensible way to do it as well. I think they just want to make sure that they're adequately diversifying within those individual fixed income holdings.
And when you're talking about short term, what are you talking about?
These are typically securities that have a duration of anywhere from 2 to 5 years, so not super interest rate sensitive.
Can you give us some examples of Morningstar recommendations that would fit into that short to intermediate term kind of fixed income type of portfolio?
Sure. So Fidelity has a fine fund, Fidelity Short-Term Bond Fund. It's pretty plain vanilla. And again, this is maybe be a recurrent theme as we talk through these ideas, Consuelo, but this is a fund that tends to maintain fairly high credit quality over time. So that's one we like. Another one would be to use an index fund. You could use, say, a Vanguard short-term bond index that would just take the shorter term component of the bond market and, of course, would have very low costs on its side and would tend to be higher credit quality as well. Another fund that our team likes is Baird, short-term bond. We think they are a superb firm in terms of high-quality fixed income exposure, and they run a good short-term fund as well.
Bucket 3, we'll move right along to that, and that is really the longest term portion of your investment. So describe what is in bucket 3 ideally, and also what purpose that serves.
Right. So this is the growth engine of the portfolio. And from a practical standpoint, if investors have done this work where they're holding maybe a 2-year cash reserve and then another 8 years worth of portfolio withdrawals in that bucket 2, in that high quality fixed income bucket, together that's roughly 10 years worth of portfolio withdrawals. So bucket 3 would be there for the portfolio's long-term growth. And this is mainly a high-quality equity portfolio. I like the idea of globally diversifying your equities, where you're holding a component of U.S. equities, certainly, but also non-U.S. equities. And this is where I might also hold other higher-risk assets. So to the extent that I wanted commodities tracking investments in my portfolio, or perhaps precious metals, or a REIT fund or individual REITs, I would hold them in bucket number 3. And the idea is that over a long time horizon, you should have positive returns on that bucket. So if you have, say, a 10-year time horizon in mind, that should help you make peace with the volatility that will inevitably accompany that component of the portfolio. But in normal market environments, it stands to have better returns, better growth potential, albeit with higher volatility than bucket 2 and certainly bucket 1.
It sounds like it would be broadly diversified, long-term growth, as you mentioned, some alternative investments, commodities, REITs. Can you give us some examples of funds on each of those categories that Morningstar, has highly rated?
We like index funds a lot because of their low cost. So index
Right.
funds and exchange traded funds, you could use a total market index fund and call it a day. You could even use a total world market index fund and really call it a day. But in terms of individual funds that we like, one strategy that I like a lot for retiree portfolios is a dividend growth type strategy. So it's not necessarily a strategy where you're reaching for the highest yields on the market, although I know a lot of retirees do like their dividend yields, but you're looking for a company that has had a series of dividend increases over a period of years. So Vanguard runs a couple that we like quite a bit, Vanguard Dividend Appreciation as well as Vanguard Dividend Growth. T. Rowe Price also runs what I think is a really terrific dividend growth fund, T. Rowe Price Dividend Growth. And the reason that the dividend growth strategy I think is so appealing in retirement is that this tends to be a higher quality subset of the total market. And so we see in a year like 2022, much better performance on the downside because it excludes some of the more volatile, higher tech companies, which isn't to say I think it makes sense to exclude those companies entirely from your portfolio, but I think you could shade a little bit more toward higher quality companies and then perhaps also maintain some total market exposure alongside of that dividend growth strategy. So you have exposure to the total market, you have exposure to some of those technology names, but you're shading the equity portfolio a little bit more toward the dividend growth, the higher quality cut of the total market.
And that's interesting that you would combine the two.
Investors can kind of think about their own risk tolerances to guide whether such a strategy is appropriate. One thing I would say is that if you really like the idea of taking volatility off the table, you could just own dividend growth and forget about the total market index. But there will be periods like the period from 2019 through 2021 where that portfolio is going to look a little bit flat-footed because you're not really participating in some of the highest growth and sometimes more volatile parts of the market, specifically the technology sector.
What about the alternative investments that you mentioned? How much of your portfolio would you put in some of these alternatives like commodities and REITs?
I don't view them as a must-have, I must say, Consuelo. Even though we saw commodities be the rare category that had really strong returns in 2022, I think that most investors, if they maintain that cash, high-quality bond, broadly diversified equity portfolio, they're getting a pretty all-weather portfolio right there. I don't see the need to layer on a lot of alternative assets. And the other reason is that, if you really want these assets to have a meaningful role in your portfolio, you probably would want to own a little bit more than the 5 or, 7 or 3% that investors sometimes kind of tiptoe into them with. So I just don't see them as essential ingredients, even though they may add a little bit of diversification in certain market environments.
Among the 3 buckets, how you would have adjusted in 2022? What were the kind of moves that you would make that would have protected you more than the 60-40 portfolio did?
Well, the big benefit of a strategy like this is in a year like 2022, you're able to pull from that cash piece. You're pretty much leaving the bucket 2 and 3 alone, but you may want to do a little bit of rebalancing, and that's one piece of bucket maintenance that comes into play that you may want to perhaps, if you haven't addressed this recently, look at your U.S. versus non-U.S. exposure. I know investors have probably gotten sick of hearing of the benefits of having non-U.S. exposure in their portfolios. Many haven't topped up their non-U.S. exposure, but investors may want to look at that kind of rebalancing.
And before we leave the 60-40 portfolio question, it used to be kind of the center of gravity in a portfolio, the starting point. Has it lost its usefulness as a model, a portfolio model?
I think it's still a good starting benchmark when investors think about building a diversified portfolio. And the key reason is that when we look over market history, in a whole lot of market environments, especially recessionary environments, we see a really nice pattern where, yes, equities decline in that recessionary environment, but they hand it off to high-quality bonds. And so that's something we saw during the great financial crisis. We didn't see it so much last year because we had a little different something going on where rising interest rates were the main thing that were bugging the market. But in a lot of other market environments, we have seen that nicely diversified pattern. I do think that holding cash to augment that balanced portfolio makes a lot of sense for people who are in withdrawal mode.
One of the major changes that we've seen in the macroeconomic environment that you mentioned earlier is inflation. So can you tell us how can we inflation-proof or at least protect each of those buckets from the ravages of inflation?
Really good question. I would say bucket 1, you're not worrying about it so much. The key thing to do there is just not overdo it. So I mentioned 1 to 2 years worth of portfolio withdrawals. Certainly 3 to 5 years of portfolio withdrawals is way too high because you'll get eaten alive by inflation. So the main message with 1 is just don't overextend yourself by holding too much cash.
Okay.
With bucket 2, I think you do want to be thoughtful about making sure you are addressing inflation. That's why I like the idea of maintaining a stake in Treasury inflation protected securities and or I-bonds. I-bonds last year were the hot and sexy asset category. So I like the idea of taking, say, a third, 25% or a third of that fixed income portfolio and putting it in some combination of Treasury inflation protected securities and I-bonds. I tend to like the short-term TIPS products, and I think here an exchange traded fund or a mutual fund can make a lot of sense, where you are buying yourself some protection against inflation, but you're not picking up a lot of interest rate related noise, which is something that we saw with some of the Treasury inflation protected bond products in 2022. They acted more like bonds than they did inflation protection.
Right.
So they had big losses due to rising interest rates. So I like the idea of focusing on short-term TIPS. The return potential is a bit lower, but I think it is a way to take out some of that interest rate related volatility. With bucket 3, I think investors will want to remember that stocks have had a good long-term track record of outrunning inflation. So even though they're by no means any sort of direct inflation hedge, so in a year like 2022, we saw inflation go way up, we saw stocks go down. They do not work as any sort of direct year-by-year hedge. But we know that when we step back and look at stock returns over longer periods of time, they typically are higher than the inflation rate.
Another cloud hanging over investors is the possibility of recession. Is there any way to recession-proof these buckets?
Well, I do think that high-quality fixed income portfolio stands to perform pretty well in a recessionary environment. So think back to the last major recession, the Great Financial Crisis. We saw Treasury bonds especially really doing their job in that environment, providing that safety that investors look to in periods like that. So that's what the high-quality fixed income portfolio will do for you in most recessionary environments. We shouldn't expect too much from our equity portfolios. In fact, we probably should expect some volatility from them in a recessionary environment.
We mentioned dividend growers, but we didn't mention dividend paying, current high-yielding dividend stocks. And where would you place those?
Right. And I know many investors inherently, especially retirees, prefer those types of securities because they do kick off that stream of income. You could potentially hold a complement of them in that second bucket to provide your ongoing cash flow needs and to help refill that bucket number one as you've depleted it. I like the idea of holding most of the equities, though, in that bucket number three, where you're even if you're emphasizing high dividend yielders, and I think that's a defensible strategy, you would want to give them a nice long time horizon, a nice long holding period of, say, 8 to 10 years.
And if there's one investment that we should all own in a long-term diversified portfolio, whichever bucket you choose to put it in, but it would probably be in bucket three, what should we all own some of, Christine?
So one I would call out is a fund called Vanguard International Value. And the reason I would point to it is that I mentioned many investors have kind of given up on their international equity exposure, but this one gives you a little bit of a twofer in that it is focused on non-U.S. stocks. It also is focused on value-oriented non-U.S. stocks. And of course, value-oriented stocks have performed a little bit better recently, but they've kind of gone through a long, dark night relative to growth. And so it gives you a little bit of a twofer. You have non-U.S. and you also have a value emphasis. And because it's a Vanguard fund, it is a very low-cost, actively managed fund. It's one that I own in my IRA, one that my husband owns in his IRA as well.
And Christine, what are the top one or two questions that all of your Morningstar readers and customers are asking you? What's uppermost on their minds?
A couple of things. One is inflation. How do we think about inflation, manage inflation? We talked about some of the ways to do that. Another is safe withdrawal rates. What's a safe withdrawal rate from the portfolio? And that's really the starting point for all of this, is that before you begin your work of figuring out what's going in each of these buckets and how large they might be, the first step is to take a look at your portfolio withdrawal, your anticipated portfolio withdrawal for your retirement, and just make sure that passes the sniff test of sustainability. Sometimes people are really confused about what is a safe withdrawal rate. We've all heard about the 4% guideline, which is founded on market history. That's a decent starting point when thinking about safe withdrawal rates. But older adults, people who have been retired for many years, it's my view that if they need to, they should take more than 4% from their portfolios because their time horizons are shorter than that sort of 25 to 30 year anticipated spending horizon that underpins the 4% guideline.
Christine Benz, thank you so much for joining us on Wealth Track and helping us build a better retirement portfolio and a more resilient one. I really appreciate it.
Thank you so much, Consuelo. Always my great pleasure.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point follows Christine Benz's lead. it is start adding some international stocks to your portfolio. International markets have lagged the U.S. for more than a decade since the 2008 global financial crisis. However, that changed last year. U.S. markets turned sharply lower under the pressure of high inflation, rising interest rates, and recession fears. So far this year, major international markets are still trading at cheaper valuations. Morningstar recently published a list of its 7 best international stock ETFs. All carry gold analyst ratings, and among those that generally do not include any U.S. companies are Dimensional International Core Equity Market ETF, iShares Core MSCI Total International Stock ETF, Vanguard FTSE All World ex-US ETF, and Vanguard Total International Stock ETF. As Ben said, gradually adding some international exposure makes sense, especially in the longer-term buckets of your portfolio. Next week, Ben discusses key retirement blind spots and how to fix them. That's in part 2 of our Building a Better Retirement series. In our extra feature, what does Ben's do to recharge from her high-powered career? We hope you can follow us on Facebook, Twitter, and our YouTube channel. Thank you for recharging with us. Have a relaxing weekend and make the week ahead a healthy, profitable, and productive one.